Hi there, this is Adam, and I want to welcome you to our Wealth Investment Group Academy education website. Throughout this video, we will review the general concept of our strategy on selling cash-secured put options on great companies to outperform the market and potentially achieve an average 20% annual return on your capital invested. At the end of the Options Value Investing course, you will learn to combine value investment along with selling cash-secured put options. In fact, even after you finish our courses, we'll be here to guide you for the first year and provide all the help you need to achieve the best results as part of your subscription. This video will take approximately 30 minutes. We made it long enough for you to understand exactly what you will get out of it, and I promise you, we will not sell you dreams or things that cannot be achieved. We're here to teach you how to be a great investor and how to follow the guidelines of the best investors in history. With that being said, let's get started. To have the best chances to outperform the market, we will be selling cash-secured put options, and we will trade them only on great companies with good business fundamentals when they are undervalued and near support areas. So what does this mean? First, let's review what it means to sell a cash-secured put option. An option is a contract between two parties, a buyer and a seller. We have two types of options, call options and put options. And for both, we have a buyer and a seller. In the meantime, you should know that for our strategy, we will always be the put sellers of the option contract. So let me emphasize this again. We are put sellers. In general, a put option is a contract that gives you the right to sell 100 shares of a stock at a strike price on or before an expiration date. But since we are the sellers and not buyers, it's quite different. As a put option seller, you will receive a premium and you will have an obligation to buy 100 shares of stock from the put buyer on or before the contract's expiration date. Then the obligation to buy will be. If the option buyer decides to use their right to close the contract before the expiration date, which rarely happens, or if the market stock price was below the strike price at the end of the contract. Based on our experience, you will likely only collect premiums with no obligation 85% of the time. Please note that we're not predicting any numbers. We're simply sharing our tested strategy throughout the worst times in the market with a success rate of 88%. So we know it works. Now back to selling options. Let's go over an example to better understand this concept. I want you to always remember this. Each option contract is 100 shares. And the three main parts of an option contract are the expiration date, the strike price, and the premium. For example, imagine that Apple is trading in the market now at $175, and we want to sell a cash-secured put option on Apple. First, we need to decide our strike price and the expiration date. Let's say we chose a strike price of $150 and an expiration date that ends in 30 days. As sellers of the contract, we collect premiums, and by taking this trade, we will collect a $2 premium fee from a put buyer. So for a contract of 100 shares, that is a premium of $200. We're doing this for a couple of reasons. First, we know Apple is a great company, and we don't mind owning the company at a discounted rate of $150, which is $25 below the current market price of $175. Second, we also think that Apple's market price is not going to drop from $175 to the strike of $150 by the end of the contract. Therefore, we have an 85% chance that we will keep the $200 premium at the end of the contract as long as Apple's market price stays above $150. Again, in this example, our contract details are: the strike price is $150, the contract expiration date is 30 days, and the premium collected is $200. At the end of the contract, we will have two scenarios play out. In scenario number 1, Apple's market price is above the strike of $150, meaning the contract will end worthless, and the seller, in this case us, can keep the premium. Now let's go over the trade details for this first scenario. The strike price we chose was 150. The number of shares is 100 since we only have one contract because each contract is 100 shares. Therefore, the total contract value is $15,000, which is the strike price of 150 times 100 shares. The premium we collected is $200. Then our total capital invested is $14,800, which is the contract value of $15,000 minus the premium of $200. The total gain is 1.4%. That is the percentage of profit we gained on 30 days, which is $200 divided by the capital investment of $14,800. And again, we will expect this scenario to happen 85% of the time. Now let's review the second scenario. In scenario number 2, the market price for Apple is below the strike price of $150 by the end of the contract. The seller will be assigned 100 shares of Apple for the price of $148, which is the strike price of $150 minus the premium of $2 per share collected. The broker will then withhold $14,800 from the seller's account for them to own the 100 shares of Apple at an average price of $148. Now let's go a bit deeper and discuss the insurance concept. Think about it this way. Selling a cash-secured put is like selling an insurance policy or contract. As a seller of the option contract, we will act as the insurance company for the duration of the contract. In order to play this role with the lowest risk possible, we need to have enough cash to cover 100 shares of a stock at the strike price in case we get assigned the 100 shares of the stock at the end of the contract. Getting assigned means that we will end up owning the stock at the agreed strike price, and we will pay the buyer of the contract or the insurance buyer. As sellers, or as the insurance company, we have the obligation to protect the stock during the period of the contract. Because of this obligation, we will collect the insurance premium. So what will happen at the end of the contract? Again, we will have two scenarios at the end of the contract. Scenario number 1, the stock we insured did not drop below the strike price. In other words, we had no accident. As sellers, or as the insurance company, we will collect the insurance premium and the contract will end worthless. Simply because we had no accident, there is no damage to cover. Going back to our previous example on Apple stock, we needed to hold and secure the amount of $14,800 for the duration of the contract period of 30 days. And for our obligation, we collected a premium of $200 simply because Apple had no accident or did not drop below the strike price of $150 at the end of the contract. The contract ended being worthless, and we made 1.4% for that month on our capital invested. Again, we have experienced this scenario happening 85% of the time. As they say, the house always wins. That is scenario number 1. However, in scenario number 2, let's assume that the stock we insured did drop below the strike price. When this happens, the seller or the insurance company will still keep the insurance premium, and we will be obligated to buy 100 shares of the stock at the agreed strike price. This actually is not a bad outcome because, as we shared earlier, as part of our strategy, we don't mind owning shares for a great company at a discounted price. Going back to our example, if the price of Apple drops below 150 by the end of the contract, then we will end up owning 100 shares of Apple, which is, of course, a great company at a discounted price of $148. Why is it discounted? Because when we opened the contract, the price of Apple was $175. And by the end of the contract, we got assigned 100 shares at a discounted price of $148. This is $27 below the market price when we sold the put contract, which again is still a great deal. Based on our experience, we can expect this scenario to happen 15% of the time. So to summarize, The insurance company concept is to either collect a premium and make a decent monthly income, or end up owning great companies at a discount. That is exactly what our strategy is all about. That actually is a win-win scenario. Now that we understand what it means to sell a cash-secured put option, we need to understand the rules of our strategy that need to be followed before we sell any put options. There are three main rules when selling cash-secured options. Rule number one, only sell options on great companies with good business fundamentals. Rule number two, when they are undervalued. And rule number three, when they are near support areas. Now let's take a closer look at each of our rules. Let's start with rule number one. We will sell contracts only on great companies with good business fundamentals. As we mentioned earlier, 15% of the time, there is a chance that we might get assigned and have to own some shares of certain companies. So we must ensure that we will end up with a great company. Owning a share of a stock is like owning a small piece of that company, and we want to be owners of great companies only. Examples of great companies include Google, Apple, Amazon, McDonald's, Boeing, MasterCard, to name a few. What makes a company great? A company needs to meet 5 sets of criteria to be considered a great company. First, they should have consistent and sustainable results, particularly increasing sales, earnings, and cash flow from operations. When looking at their financial statements, we need to see these numbers increasing year over year. The second thing the company needs is to have a wide economic moat. An economic moat is a competitive advantage that the company has over others. In other words, this moat will protect them from competitors and other new industry entrants. So in essence, they are leaders in their respective industries. So as we can see in this picture, back in the day, they had these deep water channels around castles, which are called moats, used to protect them from enemy attacks. This is the same moat that the companies we invest in need in order to keep competitors out. The third condition is that the company has a positive growth rate. This means that their business is growing each year. The fourth condition is that they need to have a high and consistent return on equity, ROE. Finally, they should have a conservative level of debt. This means they should have fewer loans and more cash on hand so they can survive bad times, including recessions. There are many ways you can evaluate a company in order to determine if it is a great company. But this is how we approach this. Throughout our course, we will teach you how to evaluate companies based on our criteria. And with your subscription, we will also provide you with a list of pre-selected great companies on a monthly basis. Now that you know which companies to sell put contracts on, let's move on to rule number 2. Rule number 2, we only buy stocks when they are undervalued. So in other words, we only sell put options on great companies when they are undervalued compared to their intrinsic value or fair value. We all know what a market price is, the price at which an underlying stock is currently trading at. The question is, how can we determine if this price is high or low? To answer that, we first need to know how much a company is worth. There are several ways of calculating a company's worth, but one of the most well-known ways is using the discounted cash flow method. To apply this method, we will be performing several calculations using a variety of financial data. As a side note, if you fall a bit behind on these calculations, we will be explaining them in our course. Or if you simply don't like doing the calculation part, we will make your life easier and provide you with a list of great companies with their intrinsic values as part of your first-year subscription. So a business's worth is known as the intrinsic value, or the fair value of the company. Now pay close attention to the following. A business is undervalued when the market stock price is trading at a price lower than the intrinsic value of the company. This difference between intrinsic value and the market price is called the margin of safety, which tells us the level of discount we are getting compared to the market price. By the way, the concept of only buying great companies when undervalued was introduced in the best book ever for investing, The Intelligent Investor by Benjamin Graham. And in case you don't know who Graham is, he is the person who taught Warren Buffett about investing. Let's use Amazon as an example. By now, we have established that we only sell options on great stocks when they are undervalued compared to their intrinsic value or fair value. We know Amazon is a great company, but we need to check if it's undervalued. To check if it's undervalued, we need to know two things. First, what is the market price of Amazon? And second, what is the fair value or intrinsic value of Amazon? Well, during the making of this video, Amazon's market price is $116, and its intrinsic value is $192. As long as the market price is less than the intrinsic value, the company is undervalued. Since Amazon's market price is $116, it is less than its intrinsic value of $192, we can conclude that Amazon is undervalued. Let's now look at the margin of safety. The margin of safety determines how much the company is undervalued by looking at the difference between the intrinsic value and the market price. 192 minus 116 gives us a discount of $76, meaning that we get a discount percentage of 60%. As Warren Buffett said, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money. By now, we have covered both rule number one, which is that we only sell put options on great companies with good business fundamentals, and rule number two, that says that we only sell them when they are undervalued. Now let's move to rule number three, timing our entries. Timing our entries means that we will only sell our cash-secured put options when the price is near support levels. For this section, having a good understanding of reading charts is very important, also known as technical analysis. If you don't know much about this, it will also be explained in our course under the technical analysis lesson. We will explain all the details so you will know how to read charts and identify support levels. In the meantime, you need to know that all stocks have support levels, which is the price floor which a stock doesn't tend to fall below. If we look at the chart of Google, we can see that the price moves on a wave pattern, up and down, up and down. The different lines you see are called moving averages. This green line represents the 150 weekly moving average. And as you can see, every time the price comes near the green line support level, it will touch it and bounce back up. You can see it happen multiple times, and now it's back to the same support level where the price is 2,124. We know the price is near the support level when it's back to the 150 moving average green line. To summarize, rule number three indicates that we need to time our entries and only sell our put contracts when the price is near support levels. Based on probability, we believe that the underlying price will go up after it is close to the support level. Let's go over a quick summary of our strategy. We are selling a cash-secured put options contract on very good companies with great fundamentals only when they are undervalued and when the price is near support levels. You should learn this by heart and make sure you always follow the three rules of our strategy. Before we start our comprehensive example, let's make sure we understand the meaning of a cash-secured put option. Cash secured means that you have enough money to cover each option contract you sell in case you get assigned 100 shares of that company, meaning you have to buy the shares. For example, if you sell a contract on Amazon and the strike price is $100, then you should have at least $10,000. Why 10,000? If each contract is 100 shares, we'll multiply this number by the strike price of 100 to get 10,000. You need to have this money available in case Amazon drops below the strike price of 100 at the end of the contract, and you get assigned 100 shares of Amazon. We strongly advise against taking any trades if you don't have the money to cover the trade. Otherwise, you will be selling naked puts, and that can create problems for you. Let's walk through a comprehensive example to pull it all together and see how this all works. For our example, we'll use the Walt Disney Company. We've studied up on Disney, and we know that it fits all of our criteria, and it is a good company with great fundamentals, so we know it meets rule number 1. Rule number 2, is the company undervalued? So we know the market price is $91, and the fair value or intrinsic value after we did our calculations is $170. Then Disney is undervalued because the market price of $91 is less than the fair value of Disney, which is $170. In this trade, our margin of safety is at a discount rate of 49%. We were able to calculate this number by dividing the strike price of $83 by the intrinsic value of $170. Another very important thing we need to check is the next quarterly earnings release date. We need to make sure our option trade will end before the next earnings in order to avoid any unexpected price changes that might happen. So our trade will end on August 5th of 2022, and the next quarterly earnings release date for Disney will be on August 11th. Therefore, our trade will end before the next earnings release date. Now that we have verified our first and second rules and checked when the next earnings release date will be, we need to check rule number 3. To do this, we need to look at the chart and check if the price is near support levels. Looking at the chart on weekly candles, we can see the price is back to this horizontal support level. So as we can see, every time the price comes near the support level, it will touch it and bounce back up. That is reflected there, there, and there. And now the underlying price is back to the same support level where the price is today, 91. Now we have verified rule number 3 that Disney indeed is near a good support level. So now our next step is to select the strike price for our trade. To do that, we will sell our put contract at a price lower than the support level, and we always prefer it to be near the next support level. Again, if we look at the chart, we can set our strike around $83, which is near the next horizontal support line, and you can see that reflected there, there, and there. We can see that when the price was near these support levels before, it did hold very well. So we have looked at the chart and did our technical analysis, and we realized that the $91 market price of Disney is near the support level, and we have selected our strike for our trade today to be at $83. Now that we have verified all our 3 rules, decided on our strike price, and checked when the next earnings release date is for Disney, let's review the trade details. The trade date is on July 14th, 2022. We're selling the contract on Disney, the stock ticker DIS. The number of contracts we are selling is only 1 contract. And as you know, each contract is 100 shares. The market price for Disney now is $91. We decided our strike to be at $83. The intrinsic value is $170. So the margin of safety is 49%. The cost of trade minus the premium collected is $8,205. And please remember, this amount must be secured before you enter the trade. The end of the contract date is August 5th, 2022. Our contract duration in days is 22 days. The next earning date for Disney is on August 11th. The premium to be collected per share is 95 cents. Our break-even price, $82.05. This is our cost price in case we get assigned 100 shares of Disney. The total premium is $95, which is 100 shares times the premium we will collect per share. Finally, our expected gain percentage compared to our capital invested is 1.2%. So if we were to go with this trade, we would expect to gain 1.2% on our capital invested in only 22 days. This is the premium we collect divided by the amount of $8,205, which we secured and invested for 22 days. So this is how the trade will look on the Interactive Broker IBKR option window. If you're not familiar with this, don't worry. We will teach you everything from setting up a trader workstation platform to how to become an expert on opening and closing trades. What you're seeing now is called the option chain. You will need to select the stock, which is Disney. Then you will need to select the ticker DIS. Then you need to select the end of contract date, which is August 5th of 2022. After that, you will go to the put side right there. Then you select the row that has the strike price of $83. Then we will move to the same row under the bid column, where you can see the red highlighted number, 0.92. So this number is how much premium you can collect per share. And the range between the bid of 92 cents and the ask of 96 cents is how much premium per share you can expect from this trade. So you click on the red highlighted number under bid to open a sell leg. All the information will go down there. You make sure everything looks good. We are selling a contract until August 5th, 2022. The strike price is $83, and it is a put. Then we make sure that we are selecting the right quantity of contracts, and in our case, it is only one contract. We set our premium to 95 cents. If we like everything, then we just click on Submit the Order. By doing this, we have submitted the order and sold cash-secured put on Disney with a strike price of $83. The trade will end on August 5th of 2022 for a premium of 95 cents per share and a total premium of $95 because each contract is 100 shares. So now what? What happens at the end of the contract? At the end of the contract on August 5th, 2022, one of two scenarios will play out. In scenario number one, the price of Disney stays above $83. The seller will keep the $95 premium and the contract will end worthless. The total amount invested is $8,205 and the total gain percentage is 1.2%. And we gain that in only 22 days. And again, we expect this to happen 85% of the time. In scenario number two, the price of Disney drops below our strike price of $83. Then we will still keep the $95 premium and will be obligated to buy 100 shares of Disney with a strike price of $83. The average cost per share will be $82.05. And remember, when we opened the trade, the market price was $91. And after 22 days, we owned Disney at $82.05. It means we owned it at a discount of $9 lower than the market price. And again, we can expect this to happen 15% of the time. Now that you understand the general concepts around selling cash-secured put options, you're probably wondering what you should expect using our strategy. Well, you can expect to achieve a 20% yearly average return on your investment if you use the SAFE strategy and follow the three main rules. And we know it is safe because it did well for us through one of the worst times the markets have seen in a long time. How is this percentage calculated? If you sell cash-secured put options and make an average of 1.5% return per month, that means you can make an 18% return per year. If you boost your return using the margin on your account and leverage it up to 30%, then your return will be 23%. If your success rate is 85% per trade, then you can achieve your returns of 20% per year. If you're not sure how to use margins on your account, we have you covered. We'll teach you how to use margins safely in a different module. For now, you just need to know that using margin means that you borrow money from your broker or brokerage account. If you have $100,000, you can borrow $30,000 from your broker. With our strategy, you will not be charged any interest for borrowing unless you get assigned and actually need to buy the stocks. This way, you can boost your returns without paying interest most of the time. With our strategy, we are combining value investing with the selling of cash-secured put options in order to achieve an expected 20% return on investment yearly. If you're wondering if 20% is good or not, let's walk through this example. Imagine we have 3 different people who currently have $61,000 in savings, and they are willing to save another $6,000 every year for the next 13 years. The 3 people take different approaches with their money using compound interest. The first person wants to play it very safe. He wants to go to bed every day knowing that his money is going to be there with 0 risk. He decides to take the mattress approach and deposit his money in a savings account with 0% annual return. The second guy decided to invest his money in real estate and expects a 5% return on his investment. And the third guy invested his money in the S&P 500 ETF SPY, expecting a 9% return on his money. Let us take a look at how each one did. The first guy wanted to play it safe with no expectations, and he saved $139,000. The second guy invested in real estate and made the 5% expected annual return. After 13 years, he has $226,000. And the third one invested his money in the SPY ETF with 9% expectation. He made $337,000. With the capital invested, he gained another $198,000 in 13 years, making a 140% return on his investment. Now let's just say a fourth guy decided to step up and control his own money. He invested using cash-secured put options safely with an expectation of 20% a year. After 13 years, he has more than $1 million. He invested $139,000 and he gained another $862,000 in 13 years with a return on investment of more than 600%. This is what a 20% can do to your investment portfolio. To summarize, in our story, we use the same initial capital, same savings, same terms, but different approaches. 0% for $139,000, 5% for $226,000, 9% $337,000, and 20% for $1 million. There are certainly many different investment strategies, but we personally like the 20% potential strategy by selling cash-secured put options. Now we are done with our strategy. I'm sure you're thinking to yourself, your strategy seems to be very simple. Why isn't everybody just doing it to beat the market? Well, there are a few reasons for this. The first one is that our strategy is safe but slow. It does require patience. Most traders and investors are very impatient and greedy. So when the market is doing well, they will look for the trades and investments that will yield them 10% to 30% per day. You may also be wondering why to follow a strategy that gives 20% per year while others seem to be doing the same number in a month or a day. Option call buyers will risk it all, go all in. And if the trade does not work in their favor, they will lose all their money. For example, when they bet on a stock and pay a premium, let's just say $300, and the stock goes up $1 from their strike, they will gain $100 and brag that they were up 30%. However, when the stock stays below the strike, they will lose all their money. And this happens 85% of the time. Can you guess who will be collecting those premiums most of the time? Yes, us, the option sellers, will be collecting them. Traders and investors seeking to become wealthy in the short term will be washed out of the market quickly, which is why less than 10% of people make money in the stock market. As Warren Buffett said, nobody wants to get rich slow. The second reason why more people aren't following our strategy is that most traders and investors don't have the stomach to stay in the market when the market is dropping. They will abandon the basic rule of investing: buy low and sell high. When they see the market drop every day, their fear will control them, and they'll start selling their positions at any cost, thinking that they can time the market and jump back at the right time. As Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. The third reason is that it is very hard not to break the rules. Many investors deviate from their plans all the time and don't strictly follow the rules, especially when the market is doing well. They think they are smarter and can make money faster, so they start trading or leveraging their accounts by borrowing a lot of money. However, once the market starts declining, they will lose most of their money, making it almost impossible for them to recover it. These are some of the main reasons why traders and investors do not make money in the stock market. They always want to get rich fast. To be an intelligent, successful investor, know yourself enough to pick the right way. Stick with it over the course of investing lifetime, and keep your costs and emotions under control. Benjamin Graham. This course will teach you all you need to beat the market while being safe and following rule number 1 of investing: not losing your money. After we teach you what to do, we'll guide you through our Telegram channel for 1 year for free. This includes a monthly updated list of the great companies that fit our criteria and their intrinsic values, immediate notification once we identify any valid trades that we think are worth taking, market updates information, and working with you to improve your investing psychology. Please remember, we are here to educate you. I hope that you become a part of our wealth investment group.